On today's episode of the Investing Revolution, I'm going to talk about the differences between the 2008 housing bubble and crash and today's current real estate market.
This is the Investing Revolution, a podcast designed to help your real estate investment strategy. On this podcast, we'll teach you the actionable steps to take and pitfalls to avoid so that your real estate investing can thrive.
Welcome to the Investing Revolution. I am your host, Jonathan Cook, and today I want to discuss a topic that I've seen floating around all of the real estate investment Facebook groups. It's national news quite often recently, but I want to discuss what's happening in the housing market today and compare it a little bit to the housing market bubble and crash that we experienced back in 07, 08, 09 in the United States. So what I've been seeing, I am in several real estate investment groups on Facebook, in Twitter, in Alignable, and several other social media apps, to where oftentimes I like to just sit in there and add in my little 2 cents to help the would-be investors have a little bit more leverage when they're doing some refinancing, or when they're trying to make a good decision on what type of real estate investment to purchase, and that kind of stuff I am happy to do all day, every day. If I can help everyone invest stronger, then we can all grow together. But recently, over the past several months, actually, since the beginning of this year, it's been right at the top of everybody's mind. Everybody keeps saying, are we in for another housing bubble? Is that what's happening right now? Because prices are skyrocketing. They have been through last year, the year before, the year before. It seems inevitable. And I want to walk through what the differences were previously and what's happening now. Anybody that's been in real estate investing for the past 20 years remembers the bubble in 07. They remember what happened, and it definitely feels very similar. Housing prices were at an all-time high at that time. It was difficult to buy a house. You would, put a house on the market and it would disappear, overnight. You wouldn't even have time to find yourself a new place to move in. And that was driving demand up really high. But the big difference between then and now was inventory. And I want to devote a little bit of time to just the difference in inventory previously to what they are now. But I want to talk about the underlying problems of what was happening previously to today. And now I'm not a certified financial planner. I'm not a mortgage person. I don't do lending. But I've been in the real estate investment market for a very long time. I started my real estate career in the bubble. I got licensed at 21 years old and experienced 2007. I sold a lot of homes in 2007. It was great. It was a wonderful time. And then when the market crashed in 08, it was instantaneously felt. I can remember having listings that sat on the market for over a year. 464 days, I believe, was the longest time that I had a listing on the market. It was a scary time. You put something up for sale, and who knows when it would sell? Who knows if your listing agreement would expire before the home sold or what? We had showings, we had listings, and everybody was chasing those prices down. You would start at $400,000 on one weekend, and 5 houses around you would drop their prices to $385 at the same time that you posted yours. So you would chase yours down to $380, and then somebody would list theirs at $375, and then you would have to. It was a race to the bottom. I can remember those times, and it was exhausting and it was scary. There was a huge recession afterwards, but let's talk a little bit about what caused that issue before we contrast it with today. So there were several related issues that caused that initial bubble. Mostly, if we want to put it on just one specific item or one specific cause, it always seems to go back to subprime lending, which that's just lending people more money than they will ever be able to afford. There's a lot more detail and definition to how that actually works. But the easiest way to explain it is giving people large mortgage loans for people that could not afford it. They couldn't afford the loan prices, all in hopes that the equity would build them enough value to where their equity would be able to shore up the distance between what they were paying and what the house is worth. And it was a big pyramid kind of deal that was happening there. It had a snowball effect, and for a while it worked great. We saw a lot of ARMs at that point in time. Adjustable rate mortgages seemed like a great practice that just let everyone have the opportunity of home ownership. The benefits of being able to get a loan where in the first year you're only paying 3, 4, 5%, and that wasn't all that bad. You could afford that mortgage payment, but that kind of hidden part in the back end was Wall Street really put a lot of effort into purchasing mortgage-backed securities, which again is, could have a whole episode in itself about just how mortgage-backed securities work. But long story short, Wall Street started betting on equity in these mortgage-backed securities because it's a relatively stable investment bet. Mortgage prices are paying at 6-7% or whatever they were returning at that time, and equity was continuing to build. It didn't seem like there was any end in sight. Builders were building homes all over the country because, hey, everybody needed a place to live. That's a great place to profit off of real estate is just buy up the mortgages. The problem was when those bubbles or the ARMs would adjust, and people had balloon payments, which I'm sure some of you might remember ballooning mortgages and how those worked. I believe the very first home that I purchased was on a balloon mortgage, which is terrifying now that I think about it. But how those ultimately work is you pay one rate for a certain amount of time, and then once they mature, 7 years, 10 years, whatever the agreement is, then it balloons and you owe the rest of the loan on the house, which is great in a flipping market. It's perfectly fine. It's a great idea when you can sell a house. It's a perfectly fine investment strategy if you can buy a house and that you'll be able to sell it for more money than what your mortgage is. When equity is climbing 20, 30, 40%, it sounds like a really safe bet. Oh, I can buy this house this year. I can buy this house today for $150,000, and we're talking 2007 money here. So you can buy it for $300,000 if next year I can sell it for $425, because even if my mortgage balloon payment comes due, well, I can sell the house for $425, pay off my $360,000 loan or whatever the loan ends up being at that point, and I can walk away with profit. So in 2008, all of those balloons and rates started hitting. We started seeing the results of all the predatory lending practices that had been really propping up the housing market for years before 2008. Homes started popping into foreclosure, and the builders were still building. So that's what we're talking about here, is a difference in inventory. And that's if we're just going to put one difference between then and today, and there are still several, there are way more than this, but I will lean really heavily on the difference in inventory from 2008 and 2009 to today. We had tons of houses on the market as the market crashed. Builders were still building, pre-existing homes were still on the market, and they just were never leaving the market. And I want to talk about what a healthy real estate market looks like. years ago when I went through my very first pre-licensed real estate course, we were taught, and it stands to reason this is pretty nationwide here, a healthy real estate market where nobody has any benefit over the other, whether that's the seller or the buyer. It's pretty equal. Has about a 6 months supply on the market. We're just going to use round numbers here. So let's say in any particular market, 100 homes sell per month. Okay, great. That means at any given time, there are 600 homes on the market. So at that point, no seller has any outright advantage over the buyers because there's plenty of options to choose from. No buyer has any significant advantage over the seller because there's not infinite houses on the market, but I have some options here to choose. There were times in 2008 where just the Birmingham, Alabama market had over a 12-month supply. That's more than double a healthy market. Your averages across the country, I believe, were well over the 9-month time frame that we consider a buyer's market. Just in round numbers, when we're talking about kind of standardized inventory amounts, a 9-month supply of real estate inventory means that, hey, it's a buyer's market in that case. There's 9 months of supply. There's 900 homes in this market that sells 100 homes per month. I can pick whichever one that I can get the best deal on. I can pick whichever one fits me the best. And, I can kind of offer whatever price that I want because there's so much inventory here. It's a supply and demand issue. There's a ton of supply and there is some demand, but, I get to be a little bit choosier. And we can relate this to any other industry where supply and demand comes into play. So now let's talk about what a seller's market looks like in terms of generalized round numbers. A seller's market looks like a 3-month supply of inventory on the market. There's only 3 months of supply, 300 properties in this 100 property a month market. If there's only 3 months of supply, well, then now the sellers have a much higher advantage than the buyers. Hey, there's only 300 properties here. We'll set the prices kind of however we want. So in terms of nationalized numbers, that's what we're talking about here. That's what makes a buyer and or seller market. So back in 2008, 2009, there were times in Birmingham that had well over a year's worth of supply just continuously. We saw homes average days on market were 90 days, 120 days, 200 days. There were several listings that were on the market for well over a year because there was so much supply and not nearly the amount of demand because people weren't able to get mortgages. People weren't able to get loans. People had just gone through foreclosure or bankruptcy. And so there weren't enough people that could get money. And then if they had the cash, or if they did build the credit, or if they did have the option to go and buy, well, there was so much inventory. You could throw a dart at the wall and, hit something nearby. Again, your basic tenets of real estate, location was very important. Benefits, features, upgrades, those were all very important, but you had to have the shiniest house on the shiniest block at the shiniest price to land that buyer at that time. Now let's look at today. I know a lot of buyers and investors feel like, it feels the same way. I mean, it feels just like 06. It feels very, very similar. Prices are super, super high. And yet that is true. And mortgages aren't quite as predatory as they have been, but hey, the interest rates have gone up. They're almost at 6% right now, which, that makes it harder for all of our numbers to work. Of course it does. When you're adding back in your debt service, now instead of adding in, $700 a month for your mortgage, you have to add in $900 a month for your mortgage or whatever the case may be on some of these, properties you're trying to make work for your cash flow strategy or your BRRRR strategy or what have you. Refinancing is, not the best option at this point because rates are now higher than whatever you're paying or what you were paying a year and a half ago. But to specifically assuage the nerves for the investors thinking this market's going to crash. This market's going to flame out and explode, and anybody buying real estate is going to be left holding the bag, and you're going to sink. I want to talk about current supply issues. So I did some research on the previous 4 years of the Atlanta metro market, and I didn't do the entire state of Georgia. I just dove into the metro area for Atlanta. Originally, I just tried to do inside the Beltway, and I got a lot of really interesting numbers. So I just wanted to see what the numbers would be to just plug into the MLS, just the whole thing. I didn't want to put any borders on it. Just wanted to see the entire Atlanta market. And since 2018, it's not just a 2020, it's not just a pandemic issue. Since 2018, we have had less than a 2-month supply of real estate inventory at any given time in the Atlanta market. That's startling. That is a seller's market. Right now, it's a 1.68 month supply. And Atlanta is a really good depiction of the real estate investment market over the country. Are there other markets that have slightly better margins? Yeah, of course. They have less demand though too. Are there some that have more demand than Atlanta? Yeah, of course. But they have less benefits, tax incentives. You have less purchasing power in some of these markets. So when we're just talking about a real estate investment market, what it looks like, how much money can be made, Atlanta is a really, really perfect market to kind of dissect, to get a good picture of what's going on in the country right now. Atlanta right now has something like 13,000 listings, which sounds like a whole lot. It is a ton of optional listings, and they range anywhere from $17,000 up to $11 million. There's anything in between there, and all kind of numbers here. But we're still talking about a median days on market time frame of 24 days. Are there properties that sit on the market way longer than that? Yeah, of course. When we talk about individual properties, what makes something sit on the market for a long time, or what makes something sell really quickly, individual properties have different reasons why something sits on the market longer or shorter versus a market, which is why I like to use medians. I think medians are much more accurate analysis tools than averages are. So when I look at the average, the average days on market is over 40. That is really hindered by the handful of properties that have been on the market for well over a year. Some of them, pushing 500 days. But, when you have a listing at $11 million, that's really, really nice. Sometimes it's okay to wait over a year to sell that property because it's going to make the money back, and it's perfectly fine. But we don't see those crazy median numbers of 2 months, 3 months. We're still seeing an under 1 month days on market time frame for retail sales in the Atlanta market. I know for the last couple of months, investors that were doing flips really were excited for the fact that they could put their property on the market on a Friday and have 25 offers by Sunday, and they could pick the best one that was the highest over market value that they could choose. They could take that and run with it and be fine. And today it doesn't feel the same because, I only got, 3 offers this weekend, and one of them was below asking price. That's less fun, but that's how real estate works. That's a normal real estate market. We've gotten spoiled as sellers over the past few years. And again, it's an inventory supply issue. There are not as many homes being built in this country as there needs to be. We have a massive shortage in a supply of livable homes in America right now. And, on another episode, I might dive a little bit further into the ethics of profiting off of housing, because that's another thing that I've been seeing, climb up some of these news trackers. But today I just want to talk about specifically why today is massively different than it was during the previous housing crash. Now, am I saying that this bubble isn't going to pop? Is even what we're in right now a bubble? I don't think that it is. Is it going to crash? I don't think that it is. And I don't have a crystal ball, certainly. But in terms of what I'm seeing here, there's a big player in today's market that operates on buying properties just across the board. If it fits the predetermined checklist items, they can just buy it. We're talking about hedge funds. We're talking about REITs. We're talking about Wall Street. They have more money, as a collective than most of us will ever see. And that's okay. But they are competing. In January of 2022, 1 in 7 homes were sold to Wall Street. That's a lot larger of a number than we've ever seen. We are seeing historical rises in Wall Street firms buying single family real estate inventory, taking it off the market and paying well over what we can pay for it, well over what I can pay for it, well over what you can pay for it, because they're not banking on today's numbers or tomorrow's numbers or next year's numbers. They understand the value of owning the real estate. The more of it you own, the more eventually you can set that price to whatever you want for rent. And that's how we can compete in the new market of real estate investing. You have to start looking in tertiary markets. You have to start looking in secondary markets. You're having to go out and buy homes that are distressed. We have to put in the work, add our own inventory back into the market. And that is what is going to let us continue to invest and continue to build equity and grow our wealth. In today's real estate market, it's a relatively safe bet to purchase distressed properties and force equity into them. You're not paying well over market value for them. You're not competing against Wall Street. That's okay if they're upside down in cash flow for a couple of months or maybe even years. We don't have to worry about that if we go and build our own inventory back into the market. And that is, a good way to start a conversation about build to rent. It's a good way to start a conversation about buying distressed homes. And you know what? I think that is the kind of mentality that we're going to have to begin to focus on to continue to be small mom and pop real estate investors. And most of us are going to fall into that category unless I have some hedge fund listeners, which I doubt at the moment. But for the rest of us, we've got to start to change our tactics a little bit. And, over the next couple of months, I'm going to talk about what we can do to kind of fight the good fight. Some of the things that we can do to continue to be relevant players in our markets. And I want to talk about the benefits that we individually can take bets on that Wall Street probably isn't going to. But, I hope today let you understand a little bit about why things are different right now than they were back then, make you a little bit more at ease on pulling the trigger to buy that investment property that maybe the numbers aren't absolutely perfect on, but you sit there and you've got to build equity. You've got to start growing your wealth, and real estate is the best hedge against inflation. So I hope this episode has made you realize, all right, you're not going to be buying something and immediately lose, half of its equity, right on day one. We're dealing with a different situation. And, I hope today's episode has really, calmed your nerves, made you ready to get back out there and really start fighting to buy the properties that are going to make you money. But thank you everyone for watching today. Please make sure to like and subscribe, hit the notification bell if you're on the YouTube channel. But thank you, everyone, and we will talk with you in a few weeks.